So first of all, welcome. Thank you all for joining us once again for our quarterly economic report exclusive briefing. This is exciting to have you here today because this is our very first economic report of 2026, and it comes at a rather important time in terms of economic perspective and political perspective in North America. I think I don't have to tell you that it's a challenging time globally and in North America in many terms. And we've been digging into it quite significantly over the past few weeks. This is the first report where we have a substantial amount of data looking back at the first 6 months of the trade dispute with the US. And this is an insightful read, in my opinion, as we head into this new relationship with the US and these new policy, including the Buy Canadian policy. So, as usual, today I have with me our economist at CCA, Yonghang Liu, who goes by Max. Max will be presenting the report. He is the author of the report for a few editions now. We'll go for about 40 minutes in terms of presentation. We have significant amount of data and slides to present you. All of this is available in our economic report, which will be published on the CCA website and was sent to you last week on embargo copy. After the presentation, we'll have time for questions. So if you have any kind of question, please take some notes and we'll turn to you at the end. So without further ado, Max, floor is yours.
Okay. Thank you, LP. Let me share my screen first. And I will assume that everyone can see what I'm seeing. And yeah, hello again. My name is Max. I'm the economics and policy analyst at CCA. I've met many of you a few times already. So without further ado, I will get today's presentation underway. Starting with an overview of the Canadian economy and national construction activities. So the Canadian economy recovered in the third quarter of 2025. That's this left-hand side stacked bar right here, with real GDP rising by 2.6% annualized to 2.5 trillion for the first time. This chart shows the contributions by component. And looking at Q3 2025, the largest area is colored in green. This is the change contributed by imports, meaning we imported less in Q3 compared to Q2. And why is that? Imports were elevated in Q2 due to the inbound shipment of large oil and gas platform module to Newfoundland. That one-time surge magnified the drop in Q3. As a result, the trade deficit narrowed by 21% to $71 billion. Other components saw small movements on a quarterly basis. Exports still remain low compared to the pre-trade dispute era, increasing only by 0.2% over the previous quarter, supported by a 6.7% higher export in crude oil and crude bitumen. Consumption fell by 0.2%, but remained relatively resilient after the boost in Q2. Now, some of the numbers that you just heard might not look like the ones I've listed here is because I was talking about their own change compared to their values from a quarter ago. These are the contributions. And final domestic demand stayed close to the Q2 level, signaling continued caution among businesses and consumers. Gross fixed capital formation, also as known as investment, increased by 0.6%. Unfortunately, businesses are still holding back further investment in construction equipment, only maintaining their Q2 levels, and the increase in capital spending was driven largely by a near doubling of the investment in weapon systems by the government. Now, how significant are the economic slowdowns for Canada? We've talked about how the trade damages our economic growth, but how much are we talking here? To put that into context, here's a chart from the Bank of Canada's last monetary policy report. The yellow line represents projection back from January, when the trade dispute was still only a risk and not a modeled certainty. The blue line represents GDP projections from the latest October report. Now let's compare them. Right? After exports have fallen, we can see that the same level of output, which would have been reached by mid-2026, the first red dot on the left here, will now be reached a full year later, around mid-2027, provided that the current conditions don't deteriorate further. By don't deteriorate further, I mean, for example, right, nothing becomes of the new US threat of 100% tariff. In real terms, GDP growth from Q4 2025 will be held back by about 1.5%. And for context, annual GDP growth in Canada has been 2% in both 2023 and 2024. So Bank of Canada's next meeting is taking place tomorrow. The central bank currently believes that underlying inflation is close to the 2% target. This suggests that rates will remain on hold through much of 2026. The Canadian dollar remains weak against the weighted basket of major currencies, although it has strengthened against the US dollar since November. The policy rate was capped at 2.25% in the December meeting, and as you can see from this table, there's a strong consensus that the bank will not change interest rates throughout 2026. So most of these numbers, whether it be predictions for the January meeting, the March meeting, July meeting, all the way until January of next year, most people agree that interest rate won't be changing in the next year or so. And this will provide a more stable financing environment for construction investments. Variation in real GDP is typically less volatile than many other economic indicators. However, Q3 2025, which is the last bar on the right here, saw a 1.3% increase. This is the largest quarterly increase in the last 3 years and a half. This marks the sixth consecutive quarterly increase for all of construction industry also. Now, in real terms, construction GDP increased from $168 billion in Q2 to $170 billion in Q3. Construction's share of total industry GDP reached above 7.3% as the sector outpaced overall industry growth, which was 0.5%, and the industry outpaced other sectors for a second consecutive quarter. Year over year, construction grew by 2.6%, while all industry average grew by 1.1%. Now, if we break down this last bar by subsectors, growth was driven primarily by engineering construction activities, colored in green, while most other subsectors remained near their previous quarter's levels. Engineering and other construction activities increased 4.4% from its own value in Q2 and contributed 1.5 percentage points to the total construction GDP growth. This represents a 3.7% increase year over year, ending the decline that was experienced since the start of 2025 and returning to its Q2 2023 peak reached during the height of LNG Canada's Phase 1 construction. To gain better insight into the engineering construction category, we created this new chart. Now, this is the world premiere of the prototype, which was not included in the report. What this chart aims to show is the change in net stock of engineering construction assets over time. That means the net change in the stock of roads, sewers, pipelines, etc. Over the last 5 years. Here, I've laid them out by province. It's a little messy, but as you can see, BC leads the country at 34%. A big part of that story will be tied to the Phase 1 construction of LNG Canada, the Coastal GasLink pipeline that feeds it. There was also the Trans Mountain pipeline expansion. Overall, very high growth in the region. Then we have our second tier of provinces and territories that still outperform the national average. These are Yukon, Nunavut, Ontario, and PEI, with growth ranging from 15% to 19%. Next, we've now reached the national average rate of 6%. That's over the last 5 years. Below that, we have Quebec, Nova Scotia, and New Brunswick, regions that, while has seen low growth in infrastructure stock, are still net positive. Lastly, we have the bottom of the class, regions that saw deterioration in their infrastructure assets. These include all three provinces in the Prairie region, Newfoundland and Labrador, and Northwest Territories. So this is just a quick demo of our brand new dashboard that will enrich the non-building portion of our report. Feel free to let me know what you think about it and if you have any suggestions. Let's get back to building investments. Now, investment in Q3 contracted by 0.4%, following a 1.3% contraction in Q2. Year over year, building investment remains 3.8% higher, but as the current pipeline of new condos gradually completes and the lowering permits in Q2 and Q3 materialize, multiple dwelling construction could drive total building investment down the next quarter. The largest driver of the Q3 declines were multiple dwelling building construction, accounting for 1.3 percentage points of the 0.4% decrease. This is still 6.3% higher than a year ago. The decline is exactly offset by the increase in single dwelling construction building constructions. Industrial construction was down by 6%, following a 5.5% decline in the second quarter. Investment in industrial building construction has declined for 8 consecutive months. Now, this is again tied to the uncertainty of businesses holding off their investments, especially in industrial production facilities. The Q3 value is almost 10% lower than a year ago, reflecting the trade dispute's negative impact. Commercial construction and institutional construction stayed very close to their Q2 levels. As the chart shows, investment in construction, particularly residential construction, is very sensitive to the changes in the Bank of Canada's interest rate. So as you can see, most of these, the largest areas has been either the green area or the teal area, so either single dwelling or multiple dwelling building constructions. And as the banks, they move to the sidelines and monetary easing stops, we won't be seeing as much impact from this upside risk in the next few months, though the overall financing environment has become more conducive. Provincially, 5 out of 13 provinces and territories recorded increases. Building investment in Manitoba is up for a second quarter, which is 22% higher year over year. New Brunswick saw a dip of 8% following a 7% increase in Q2, so that's still up by 14% year over year. Ontario declined for a second quarter in a row, down by 3% after a 5% decrease in Q2. The province accounts for 1.2 percentage points of the total 0.4% national decrease and is down 1.3% compared to itself year over year. Let's take a look at the value of building permits to see how much shovel-ready work are in the pipeline. We've introduced this chart the last time, so let me just go over it quickly again. The line in orange represents the value of building permits issued. The dotted line below highlights the quarterly change for all buildings. Lastly, these stacked bars shows the composition and contribution to that overall quarterly change by each building type. Value of permits approved in Q3, the second last bar here, set at $32.5 billion, down for a second quarter by 5%. In terms of vertical construction, this is a rather drastic downturn in the last 2 quarters, so Q2 and Q3, only comparable to what we saw in the beginning of COVID. Most of the decline comes from the drop in new condos, accounting for 8.4 percentage points of the total decline in Q2. So that's the area colored in teal. Compared to itself, multi-residential permits was down 19% in Q2, then just remained low in Q3, while single dwelling building construction contracted as well. Now, institutional buildings was the only positive driver back in Q2, driven by a mega permit issued to the South Niagara Hospital. So in Q3, the numbers reverted back and showed up, negative along every other category. So all that being said, if we look at the last bar here, early estimates show a rebound in the last quarter of 2025. Although the number is still pending for December, we can expect a quarterly increase about around 10%, driven mostly by recovery in multiple dwelling permits, represented by the area colored in teal. We're also aware sometimes that developers need to like reapply to get these permits renewed. They have a 6 month window every time after they get the permit. So it could also be influenced by the fact like a lot of projects hasn't broken ground in Q2 and Q3, and now's the time to get them renewed. But overall, this is still a positive signal. The first time home buyers GST rebate, part of Bill C-4, also included in the federal budget, is currently pending its second reading in the Senate. This program would also help strengthen demand for new apartment builds once it's passed. Nearly a year after Justin Trudeau's resignation, Prime Minister Mark Carney's government introduced their first federal budget. This budget places a strong emphasis on investment and construction. For the industry, the budget means a steadier pipeline of work, new labor force measures targeted at skilled trades, and opportunities to grow and innovate. The quarterly focus of our winter issue dives into new measures introduced by this budget. Starting with an overview of the budget's composition, $280 billion. That's the pie chart on the right here, on the left here. This is the capital investment figure often seen in headlines. It represents the total accrual cost of the federal capital investment plan over the next 5 years. This includes both measures that were previously planned and newly announced. As a result of that, not all funding is new spending. Many initiatives could be continuations of previous initiatives or plans that have been repackaged, reannounced, or reworked. What we're really interested in is what's new. And in total, Budget 2025 introduces almost $90 billion in net new spending over the next 5 years. That's this gray share right here of the chart on the right. $32.5 billion of which are classified as capital investment out of the $90 billion and is colored in purple here. The government also aims to achieve nearly 60 billion savings in federal operations, mostly through workforce reductions. This means that new measures before planned operational savings amount to almost 150 billion, with about 22% of that classified as capital investment. And this brings capital investment share of the total expenses from 5.4% in fiscal year of 25 to 8.5% in fiscal year of 2030, with capital investment nearly doubling in real amount. So in a nutshell, although not quite generational, this is indeed a very capital-intensive budget. While the vast majority of federal spending will still be tied to social transfers, the share of capital investment is much more significant among brand new measures. Here's every construction envelope introduced in the budget that we've identified. In total, the budget sets out almost $32 billion in new construction spending over 5 years. That translates to around 7.5 billion annually. The three largest initiatives are the generational infrastructure investment, which includes 9 billion from the new Build Community Strong Fund, the Build Canada Homes, which will cost 6.7 billion in fiscal funding to launch, and the capital transfer piece in the increased military spending that sums up to $4.7 billion. Among the rest, 75 million will be spent on expanding labor force. That's this item right here. This includes funding to UTIP and also the Foreign Credential Recognition Action Fund. While no new funding was allocated for foreign credential recognition, the program will redirect existing resources to focus on recognizing medical and construction credentials instead. We've written very detailed notes on each of these measures in the report, and I encourage you to read more about them if you're interested. You've all also received a copy of the GR note on the day of the budget. Due to the limitation of time, today let me just go over the very high-level themes and discuss the part that developed more recently. But before I do that, I want to take a brief moment to talk about the flagship infrastructure envelope. The number that comes up most often about the Build Canada Strong Fund is $51 billion. It's important that we recognize three details about this fund. So one, the $51 billion is for over 10 years instead of the 5 years that's usually planned for other programs. Two, the fund is split into three streams, a provincial and territorial stream with $17 billion in funding, including a $5 billion over 3 years for the Health Infrastructure Fund, a direct delivery stream with $6 billion in funding, which requires private investment participation to be eligible, and a community stream with 27.8 billion and 3 billion per year afterwards ongoing, but is entirely rebranded from the existing Canada Community Building Fund. So that brings us to my third point. Project selection under the community stream will consider factors such as the use of unionized labor, the use of community employment benefit agreements, and outside of BC, these requirements were not part of the previous Canada Community Building Fund that the community stream was rebranded from. Beyond being more capital intensive and construction intensive than previous years, Budget 2025 is notable for three recurring themes. First, the word catalyze appeared 35 times in the budget, signaling a clear strategic intent to prioritize policies that attract private investment. It reflects an understanding that generational projects cannot be accomplished through public spending alone, but rather through partnerships. This approach aims to limit the size of the fiscal deficit while using PPPs to enhance the economic viability of infrastructure projects. Second, the budget strengthens the Buy Canadian requirements for steel, aluminum, and lumber in not just federal procurement, but also for crown corporations and future federal funded projects. We will discuss more details on that shortly. Third, the budget places a strong emphasis on the use of unionized labor for program eligibility. While labor policies focus heavily on construction industry, which we like to see, their scope is often limited to unionized labor. So the headline of the Buy Canadian policy is about steel, aluminum, and wood products, right? So, as they are defined in the policy, these products must be produced in Canada when the relevant material value meets the $250,000 threshold. However, that's not the only new policy. So I created this table to demonstrate the impact. There's the impact on bidder eligibility, there's the impact on bid valuation, and the material at delivery. This table should be read from top to bottom. Starting with the second column here, about bidders. The reciprocal procurement rules were already in place since last July. It dictates that the prime bidder for most non-defense procurements have to be either Canadian or from a free trade agreement partner country. The rule is currently based on location of the bidder, but will be changed to be based on the origin of goods and services provided by the bidder. A new addition to is that the strategic procurement rule. This will apply to most competitive procurements, defense or non-defense, meeting the 25 million solicitation value threshold. After June 15 this year, the threshold will be lowered to $5 million. Now, the strategic procurement policy also adds a Canadian supplier preference, a 10% reduction to their financial proposals for the purpose of evaluation only. Moving on to the third column and stacking on top of the 10% reduction for bidders, 25% of total evaluation weighting will be allocated to Canadian value added, which considers not only the material and goods used, but also services. The contracting authority can choose either a point-rated system or a price-based system, which would involve different formulas. One important detail here is that the three mandatory Canadian materials won't be double counted. So Canadian lumber, for example, would not count towards the Canadian value added evaluation for purposes of for this purpose. At this point, we went over checks on the bidder and new evaluation rules on the bids. After that, we get to the materials used in delivery, where if the value of the solicitation is above $25 million, then all steel, aluminum, and wood products procured as defined in the policy needs to be procured in Canada, produced in Canada, if one of the three materials used is worth more than 250,000. This rule applies at the material level and not the product level. That was the Buy Canadian policy with both hard requirements on the bidders and materials and preferences on the bids. Let's move on to tariffs. Announced on November 26, 2025, effective on Boxing Day, the federal government expanded the list of steel derivative imports facing tariffs. Targeted steel derivative products, including wind towers, fabricated buildings, fasteners, and wires, now face a 25% global surtax, and no country is exempt. In addition to that, the tariff-rate quotas for steel mill products were tightened. Take a look at this chart. The dotted line represents the 100% of 2024 import volume for a given product category from a given country. These TRQ-based surtaxes did not exist in 2024. Then in June, they first took effect for countries Canada has no free trade agreements with. That's what we call non-FTA partners. The annual quota was set at 100% of 2024 import levels, so the red area represents the part facing the additional 50% tariff. In August, the non-FTA quota was tightened to 50% for non-FTA countries, and non-CUSMA FTA countries also face a surtax for the part above 100% of 2024 levels. Then effective since Boxing Day, the quota was further lowered to 20% for non-FTA countries and 75% for FTA countries. So as the red area grew over time for both groups of countries, the total amount of tax paid by Canadians increased as well. Effectively, almost all steel imports from major exporters like China or Turkey face an additional 50% surtax. Our last theme of the budget, unionized labor, was referenced 34 times in UTIP-related and funding requirement texts. This approach creates a structural bias that may disproportionately affect different geographic and demographic groups. For example, Quebec construction workers are generally required to join one of 5 recognized unions, resulting in a 59% unionization rate, compared to with just 23% among the rest of the provinces. Such policy could skew access to funding and opportunities and reinforce existing regional and sectoral disparities in the workforce. Our next topic is business conditions. In Q3, 18% of construction businesses reported a major negative impact from Canadian tariffs on goods purchased from the US suppliers, while 14% reported major negative impacts from US tariffs on goods sold by businesses in Canada. These findings highlight the industry's exposure to cross-border supply chains, especially for materials that are difficult to produce domestically from scratch. In contrast, only 5% of firms reported major positive impacts from the elimination of interprovincial trade barriers. The survey also finds that 10% of construction companies were forced to change their suppliers as a result of the trade disruptions. Business expectations at the start of Q4 2025 has remained stable, especially when compared to the first half of the year. 18% of firms reported they do not expect significant obstacles in Q4, which is only 2.5 percentage points less than the share in Q3. Among the 10 most cited obstacles, half are cost related and 2 are labor related. Inflation remains the most cited concern, although it has eased significantly over the last 2 quarters, down by 5.2 percentage points in Q4 to less than 50%. At the same time, insurance costs resurfaced as a major concern, increasing by 7.1 percentage points and returned to its Q2 levels, ranking second overall. Concerns about recruiting skilled employees and labor shortages also increased, up by 3.5 percentage points and 5.4 percentage points, respectively. The share of firms concerned with transportation costs rose significantly, up by 6.8%, reflecting challenges rerouting supply chains due to Canadian tariffs and procurement restrictions. Despite a 50 basis point interest rate cut in the second half of 2025, the share of businesses reporting difficulty maintaining sufficient cash flow or managing debt increased by 6.8 percentage points to 23%, placing it in the top 10 obstacles. Provincially, Alberta was the province most affected by cost-related obstacles, with 87% of all firms expecting such challenges. The share of firms citing higher insurance costs and higher input costs both increased by more than 30 percentage points. Nova Scotia and New Brunswick also experienced significant increase in the cost category, and roughly 65% of firms reporting cost pressures. For labor-related obstacles, Saskatchewan and New Brunswick were most affected, rising by about 23 percentage points in both provinces to more than 65%. Overall sentiment is most pessimistic in Alberta, New Brunswick, Saskatchewan, and Nova Scotia, while firms in Newfoundland and Labrador, Manitoba, British Columbia, and PEI are more optimistic. Another interesting statistics is consumer confidence.
Sorry. I got a quick question. Just go back to that other slide real quick. I'm a little bit skeptical about for BC, if we're looking at particularly recruiting skilled employees, it's showing a very positive number, and yet we've got some of the highest cost of living. Recruitment is proving a challenge. This is contrary to what we're seeing. How has this been aggregated into this data? And go for that one.
Yeah.
And same with the next one, shortage of labor force.
Yeah, certainly. So one of the reasons is because we're producing a quarterly report, these numbers try to show the changes compared to the last quarter. And so, the absolute value of like what percentage of firms is sharing that concern this quarter is not apparent from this table alone. You can look at our report for more detail, but that could be like one of the reasons. This reflects more on the change instead of the state.
Okay, so it's changing from it sucks to it sucks less. Is that kind of how I can read that? Okay.
Yeah. And obviously, these obstacles are like shared among all construction firms in Canada, right? And it's something that CCA advocates for constantly. So, this is not to say that it's not a problem. It's like it sucks less in some regions compared to others, and it sucks less, in Q4 compared to Q3. That's more like what we can conclude from this. Yeah. Okay.
Thanks.
Thanks for that question. So the other interesting statistics is consumer confidence. Today we saw the macro indicators. Uh, they are looking okay, at least better than a lot of them better than expected. And a lot of the national challenges are contained, in fact, within the export-heavy manufacturing sectors. This doesn't match 100% with a lot of the sentiments that we hear daily. And indeed, if we look at the Canadian Survey of Consumer Expectations indicator, confidence remains low. They were on the rise from Q4 22 to Q4 24, with a brief dip in Q4 23. However, since the beginning of Trump's term in 2025, we've seen consistently low consumer confidence right up until the last quarter of 25. There's a term popular on the internet that describes this phenomenon called wipe session, which refers to when we're technically not in a recession, but most people feel like we are in one. Moving on to the labor market. Payroll employment of the industry stayed at the same level in Q3 compared to previous quarters, up by about 600 jobs. Most provinces recorded changes of less than 1%. Notable exceptions include Newfoundland and Labrador, where employment rose by 1.8%, and Alberta, which saw employment contracting by 0.5%. Yukon saw a higher decline rate of 5.6%, but only amounts to about 100 jobs in absolute terms. Among subsectors, land subdivision employment fell by 1.7% over the previous quarter, continuing a slow downward trend since the pandemic. Employment in residential building construction decreased by 0.6%. These levels remain elevated, but have been sliding in all 3 quarters last year. On the flip side, other heavy and civil engineering construction, such as parks, ports, power plants, and light rail construction, they're up by 2.4%, contributing more than 800 jobs. Building equipment contractors expanded by 0.4%, continuing a long-term growing trend outside of some brief COVID-related disruptions. In the first 2 months of Q4, the total number of people employed in construction decreased by 0.7%, about 11,000 people fewer in absolute terms. Year-over-year, self-employed and salaried employees combined is still 0.4% higher than Q4 last year. The largest regional contributor to the decline are Quebec, Ontario, and Nova Scotia. Job numbers in Quebec were down by 2.1%, fell 5.5% year over year. Nova Scotia was down by 1.2%. Ontario dropped by 1.2%, but sits very close to the level from a year ago. In contrast, all 3 prairie provinces posted gains this quarter. Job numbers in Alberta recovered by 1.7%, close to last year's level during the same quarter. Manitoba rose by 3.4%, and that's up 9% year over year. Saskatchewan saw a 2% increase, which translates to a 7% gain year over year. Overall, the number of workers climbed rapidly during the second half of 2024, reached a peak in January 2025, but has been slowly sliding downward, very slowly. Vacancy levels were low in July and August at around 36,000, but slightly recovered in September and October to more than 38,000. 36.4 thousand vacancies were posted during the third quarter, to be exact. This has come down since the peak near 90,000 and is 11% fewer compared to Q3 of 2024. The decline is likely tied to the decrease in apartment permits. Unemployment went up by 17,000 from Q1 to Q2, then eased by around 5,000 from Q2 to Q3. That, combined with the lower number of vacancies, make it actually easier to hire right now, at least compared to previously. About 3 applicants for every vacant position. That's up from 2.4 ratio in the first quarter. However, November saw a sharp improvement in unemployment rate, which is not displayed here because the vacancy data comes after that. And unemployment declined by 1.6% from October to November in a single month, then maintained at 5.4% in December. So labor bottleneck could tighten in 2026 with the early signs of recovery in building permits as well. So last but not least, let's take a look at recent developments in costs. If we break the cost of building construction by master format divisions, we can see that nationally, the fastest rising categories in Q3 on the left here, they are plumbing and structural steel framing, which has increased by 10.2% and 9% year over year, respectively. So these percentages are not over the last quarter, but rather compared to a year ago, because price data are not seasonally adjusted, and this gets rid of that seasonal bias. Metal fabrication division is another major driver of the overall increase due to the intensifying steel tariffs. This is unlikely to mark the end of such a trend, given the additional tariffs and Buy Canadian policies that we discussed earlier. Regionally, 12 out of 15 CMAs posted growth above 3%. Linden has the highest growth once again, with an 8.1% increase, and that's up from the 6.9% we saw in Q2, followed by Quebec City, which rose by 7.5% from 6.4% in Q2. And in both regions, growth was driven primarily by more than 15% increase in steel-intensive divisions. At the other end of the spectrum, the 2 lowest rising CMAs continue to be Halifax at 1.9% and St. John's at 2%. The BCPI for industrial, commercial, and institutional construction rose by 4.2% year over year in Q3, the same magnitude as the year over year change in Q2, but that was revised upwards from 4% as the BCPI index typically does. They get revised upwards after being first published. High-rise apartments, on the other hand, saw slowing growth, up by only 2.4% in Q2. That's down from the 2.8% in Q2. Low-rise apartments were up 4.4% year over year, largely the same as the rate of growth in Q2. Within the non-residential category, factory buildings again recorded the highest year-over-year increase at 5.7%. That's up from the 5.1% in Q2. Office buildings were up by 3.2% year over year. That's down from the 3.9% in Q2. Cost increases for other building types remain close to the overall 4% average. Construction enters 2026 with steady momentum, supported by stronger than expected permit values late in 2025. Lower interest rates have helped support activity, but the rates with them now on hold, momentum from the increased liquidity will fade in the coming months. Resale activity has improved, but weak apartment pre-sales continue to slow new multi-residential projects. Building construction costs remain elevated and represent a major ongoing risk. Buy Canadian policy and tariffs are creating uncertainty around where materials can be sourced from and how much they will cost. As these requirements expand and CUSMA trade talks approach in July, contractors should expect continued pressure on pricing, supply chains, and compliance requirements. The federal budget has been tabled, but important details still may change through the Budget Implementation Acts. Fiscal policy has turned strongly expansionary and construction intensive going into 2026. However, operational cuts and procurement restrictions could slow approvals, especially for projects not prioritized by the major project office. Changes that could affect project timing and eligibility will be closely monitored. Labor demand is expected to rise as the national push to build materialize into a pipeline of new construction projects. At the same time, immigration policy is now targeting lower inflows and a smaller share of temporary residents over the next few years. This brings labor availability back into the focus and making 2026 an important test of whether programs like the UTIP and the Foreign Credential Recognition Program can meaningfully improve labor shortages. That concludes my presentation for today, and I'm happy to take any questions.
Thank you, Max. I appreciate, as always, your presentation and your insight. We have about 10, 12 minutes for questions, so I'll welcome you to raise your hand, use the hand raise function in Zoom. As a quick reminder, this is a recorded session that will be shared, so if you prefer not to speak on camera, feel free to put your question in chat. I'll read that to my best capacity. Pour mes collègues francophones, si vous voulez poser une question en français, ça va me faire plaisir de faciliter l'interprétation et de vous donner une réponse dans nos meilleures capacités. And in case anyone has to leave before 12:30, please use this. Let me use this opportunity to remind you that the block of room for the conference is closing Friday next week on February 6th. So if you haven't booked your room for the conference and you're coming to the annual conference, please have a look sooner than later. Let's start with one of our very regular, Mike Carter from London.
Hey, everybody.
Hello, Mike.
How you doing, Max?
Hello, you're on the line.
Can you hear me?
Yeah.
So the question that I have, I guess, is multifaceted. Sort of starts with the Carney speech at the World Economic Forum, which was a once in a generation sort of speech, and it's open to LP, Rod, and anybody else that wants to comment. So we have all this nation building desire, and my questions are, how are we going to invest in it? Is it the expectation of Carney that the trillions that have flowed out of Canada, largely through pension funds and whatever, is going to be repatriated back to Canada, largely vacating the United States? So you end up with, I guess, probably more of a Japanese model where the folks in the country consume the debt to invest. And then when you look at the workforce, if the Fed's ever queried me as to what we could do, because I suspect you would need to double the workforce in probably about 3 years. The last time it happened was during COVID. And in Ontario, if you were to take the GTA, they shut down the airport, gave everybody a hammer and said, go frame houses. But nation building projects are not necessarily about framing houses. They're very large, complex engineering industrial complexes. And where are we? Is anybody? I think you're going to have to restructure the trades. Perhaps not painters and drywallers, but welders, ironworkers, boilermakers, big trades like that are going to have to be restructured. And has there been any discussion about that kind of thing? And last is, so there's lots of chitter chatter right now about high-speed rail. High-speed rail, I think, actually, I sent a note to the board saying boondoggle in progress. So now they're talking about tunneling. And I think the estimates I saw were for an investment of $60 to $90 billion. So I would say $90 billion plus. And is that part of nation building? Because the numbers that you see for nation building, I mean, it's just a humongous, silly project, but I don't see that it would be part of nation building. So there's the question. Answer however you want.
Do you want me to go first, Max, or do you want to jump in? Because there's a lot there.
I would answer
Go ahead.
Mike's
I'll
first
complete.
question, and then I know LP would know a lot more about some of the rest. So, as I mentioned in the presentation, the federal government, from the budget, we can see an understanding that many of a priority to attract investment and like private investment, even if it means it's from abroad. That means not piling on to, the national debt. The government isn't exactly planning to take on more debt to finance the projects themselves. And as you can see, um, the actually the launching of the major project office here, right? That only has a 5-year budget of like $244 million. All the major nation building projects that are managed by the MPO, those are not being financed by the federal money. They can be financed by the infrastructure bank. They can be financed from other sources, but the MPO office only coordinates. And to your other question, the railway is almost certainly a nation building project, but that part of the money is just not coming exclusively from the federal budget.
Thank you, Max. I'll quickly add to this last point, and I'll bounce the other question. I'll try to keep that concise because we don't have a lot of time. So Max already pointed out the MPO is a faster approval, streamlined project to remove red tape. It is not a financing bodies, right? So when we look at high-speed train, for example, we'll look at the Alto project between Quebec and Toronto, which is very much in the news lately. I must say, Rod and I have met with them recently. They're really eager to consult with industry. We're working on a broader consultation with the membership in the coming weeks. They are a big figure, in a way, a poster child of the MPO. And I think it is paramount for the government to succeed in that project and show that they can move forward with it in order to keep confidence of Canadians. This is why we've seen the recent announcement for the first leg. This will be between Montreal and Ottawa, the only leg that cross two provinces. There are significant challenges for the Alto project and other large-scale projects when it comes to facing the dynamic of the industry and especially the supply chain. In this case, tremendous amount of steel to create said rails. So I think those projects are very much nation building project. And if you look at the fourth line on the chart here, which is the envelope for new trade infrastructure strategy, this is something that is a direct response from government to the joint campaign that CCF done with road builder organization across the country for CTIP, the Canada Trade Infrastructure Plan, where we've been asking for many years to invest in trade infrastructure to allow us to diversify our trade amongst ourselves between provinces, but also to new market other than the US. So we are seeing the government interested in investing here. We're talking about $4 billion in that pocket. The problem is we're still very early in terms of where that money will go and what will be prioritized. This is currently with Minister McKinnon, and we're hoping to get more detail in the coming weeks and months. So that's what I would say briefly on the MPO and major project and rail. Your first question was on the overall political landscape and the speech at Davos from Prime Minister Carney. There's two things happening politically right now within PMO and within the government. On one side, the Mark Carney CEO, former bank governor that we know, is on a year-long trade mission. He's really trying to look at how we can, in a way, improve Canada's state as a trading partner and trading nation. And this is why we've seen discussion with China. This is why we've seen him going all across the world, trying to secure these localized deals to offset some of the challenge we have with the US. But first and foremost, he's a politician and he's the prime minister. So I think we need to all be mindful when we listen to the speech in Davos, when we listen to media coverage this morning from the US Treasury saying that he rolled back these comments with Donald Trump. A lot of that is a political game with the US, a political game on navigating the difficult relationship we have with the White House, but also leading into this CUSMA renegotiation, which is coming up in just a few months. I'm a firm believer that a lot of what we've seen in the last year in terms of tariff and trade war and tension is really, first and foremost, posturing from the US to put themselves in a positive position to negotiate the CUSMA renegotiation. I will say, however, because there's a lot of misconfusion there, CUSMA is not going to die in July. This is not a negotiation to end or continue CUSMA. This is a negotiation for a 16 years expansion once it ends in 2036. So regardless of what happened this year, CUSMA is still there in December. The exclusion to that is that any party can withdraw at 6 months notice. But this was the case last year. And if Trump wanted to withdraw back in March or back in November, he could have done so. So I just wanted you to keep in mind that the next 6 months will be a lot of political theater in terms of positioning our nation toward that negotiation process. Hopefully that answers some of your question. We have 3 more minutes. I don't see any hands up, but if you have a question, now would be a great time to put it up.
Yeah, LP, I don't know how to put up my hand there. I can't see
good.
that, but it's Brandon. Thanks, Max. Thanks, LP. I have one question regarding tariffs in the U.S. The Trump government had announced a $1 million tariff on Chinese-built cargo bulk vessels docking in U.S. ports, and then the trade representative stalled that for a year, I think around October. Just wondering if you have any insights as they reconsider that, or is that just completely a political thing, or is there actual analysis going into that, and what can we expect? Wondering if you have any insights.
That's not a priority for my analysis purposes because obviously the construction industry is very domestically oriented, and in that story, Canada's really not part of that. But I would say a lot of what's happened with these negotiations that other countries have done with the U.S., for example, what Korea has the deal that they've negotiated has not materialized, and Trump is now increasing tariffs on Korea because of that. Like there were a lot of negotiations done, but they're always developing with Trump in the White House. So I think that's just the kind of the type of situation that we're dealing with. Like it's never ending, right? It's not like when they announce it, when Trump tweets about it, and all of a sudden it's enforced. That's just simply not the case nowadays.
I'll just jump in. I don't have an answer to your specific question regarding that plan and where it is. We can definitely look into this. I will say one thing, however, that is directly related. And Max, can you go back on the master format slide with the 15 CMAs? And it has to do with Canadian imports and the need for Canadian supply for construction through the US from other nations. At the beginning of the trade tension, this was a significant challenge. How do we get that material that comes from China or Europe but goes through US port or is being purchased in the US and then resold to us? And this is why when we had that briefing 6 months ago in our very first report post-tariff, we said there's an issue with HVAC system, with electronic system, because all of that is Chinese material coming to the US, sell to us by US companies. You can see already in the change in master format that there's a correction happening. These 4 outlier on the left side is all metal related goods: steel framing, metal fabrication, conveying equipment, and plumbing. This is where the current steel tariff really have an impact. If you look on the right side, however, you see some of the easing situation, HVAC being the most visible, going down from 4.3% last quarter or second quarter down to, is it 1.4, Max? Yeah, 1.4 in Q3. So what you can see here and what this showcase is that Canada and manufacturers and suppliers are finding new alternative to reroute the supply from foreign market to Canadian market through Canadian ports. So I think while your question is relevant and something we should monitor, what we can see is the Canadian supply chain now getting pretty good at going around the US. We see a lot of manufacturer that used to be based in the US now being based in Canada, with some manufacturing moving to Quebec, for example, recently, or other nations that are not impacted, such as Brazil, for example. This is especially true for heavy equipment, which was a big concern in the first few months. Hopefully that helps the analysis. It is 12:30. I'm sure people have a lot of questions, but I don't want to drag this too long. So I'll wrap this up here. If you have any specific question on the report, on the data, on the analysis, please feel free to reach out to myself, Max, or Rod at the CCE office. We'll always be happy to discuss with you and provide you perspective on this analysis. This report, as of today, is now public. Feel free to share it with your member as you see fit. And of course, keep an eye for ongoing analysis over the next few weeks and months. So without further ado, let's wrap things up. Thank you again for joining us for this economic update, and we will see you the next quarter.